Hello everyone, and welcome back to today's masterclass. Today, we are taking on an absolute boss fight of an exam question. We're looking at CA Final FR May 2022 question 2C. This is a solid 8-mark question that tests two of the trickiest concepts in IND AS 115 at the exact same time. Students often panic here, but trust me, by the end of this session, you are going to absolutely crush this in the exam. So keep your focus right here, get your pen and paper ready, and let's dive into it.
Our agenda for today is super clear. First, we'll understand the card limited challenge. Then we'll look at the CarLock's return rules and do the math. After that, we'll tackle the nut bolts volume rebates and the variable pricing logic and wrap it on up with a final exam recap.
Section 1. The Card LT Challenge. Now there's absolutely no need to panic, because we're going to divide this complex problem into two distinct halves. The hero of our question is Car Ltd., a company operating in two different segments. On one side, we have CarLocks, which have a simple 30-day full refund return policy. This is where the IND AS 115 right of return concept kicks in. On the flip side, we have nut bolts, offering retrospective volume-based pricing, meaning as the volume goes up, the old rates actually change. That's where we apply variable consideration. The accounting treatment for both is completely different.
Section 2. CarLock's return rules. So, let's focus entirely on the first half of the question, the CarLocks. You can completely forget about the nut bolts for a second. What does paragraph 5.59 of IND AS 115 actually say? It explicitly states that revenue is only recognized for products that are not expected to be returned. The standard literally says revenue would not be recognized for the products expected to be returned. For that expected return, we have to create a liability and an asset. Concept clear? The goods you expect to come back, you simply cannot book that revenue on day one.
This means we have to follow exactly 3 steps for the accounting. Step 1, we calculate our confirmed revenue, meaning the portion that's actually sold and won't come back. Step 2, we create a refund liability for that 4% estimated to return, and we calculate that at the selling price. Step 3, we book an asset for the right to recover those returned goods, but this one is calculated at their cost. These 3 steps need to be crystal clear in your exam answer.
Section 3. CarLocks, the math.
The rules are clear, right? Now let's hit the direct math. What are the figures in the question? Card Limited sold a total of 20,000 locks. The cost of each lock is 1,500 rupees and the selling price is 1,800 rupees. And from past experience, their estimate is that 4% of the locks will be returned, which means 96% will not be returned. Boom. There's your first answer. How do we get the revenue? We take the total 20,000 locks, pull out the 96% that aren't coming back, that's 19,200 locks. Multiply those 19,200 locks by the 1,800 rupee selling price. So 19,200 times 1,800 gives us exactly 34,560,000 rupees. That is your recognized revenue.
Now, what about the remaining 4%, the 800 locks that are coming back? For those, we create a refund liability. Remember, we have to refund the customer the selling price, right? So 800 returning locks multiplied by the 1,800 selling price, that comes out to 1,440,000 rupees. That's our second figure.
But wait, boss, when that customer returns the lock, we are getting inventory back, right? The standard says we must recognize an asset for this right to recover. But the asset is recorded at our cost, so 800 locks times the 1,500 cost per lock. The total comes to 1.2 million rupees. And with that, we have perfectly solved the entire accounting treatment for CarLocks. Full marks for part 1.
Section 4. Nut bolts, volume rebates.
Take a deep breath. Now we shift to the second half of our question, the nut bolts. The game is a bit different here. There's no right of return. Instead, it's all about volume rebates. Initially, the contract price is 200 rupees. But if the volume crosses 50,000, the price for all previous units drops to 190 rupees. The question tells us that in the first quarter, we've only sold 24,000 units and billed them at 200. But what is management's estimate? They know that total sales for the year will be around 90,000 units, meaning the final volume will definitely land in that 190 rupee slab. This right here is crucial.
Section 5. The variable pricing logic.
Now here is where a major conceptual shift happens regarding variable consideration under IND AS 115. This is where most students mess up. I know exactly what's going through your head right now. You're thinking, sir, in Q1, we've only sold 24,000 pieces, right? So why don't we just book the revenue at 200 rupees per piece? We'll deal with it when we cross 50,000.
Honestly, the doubt is totally natural. But that is not how IND AS 115 works.
The answer to this is in paragraph 7.1.2 of the standard, estimating variable consideration. Here, we use the expected value or most likely amount method. Let me give you a real-world analogy. It's like taking a prepaid cab. If you already estimate that your final destination is 90,000 units, you assume the bill for that destination's rate right from day one. We cannot book Q1 at 200 because we already know it is highly probable the final rate will be 190.
Because of this, our transaction price is strictly locked at 190 rupees, right from the very start of the year. Even if we sent the customer a bill for 200, the revenue is going to be booked at 190. The extra 10 rupees we're collecting, that is our liability, which will be adjusted later as a rebate.
So the math becomes super simple now. In step 1, we calculate the Q1 revenue, 24,000 pieces sold, multiplied by the expected transaction price of 190. And in step 2, for the extra 10 rupees we billed, we create a rebate liability provision. Let's look at the final numbers.
The true Q1 revenue for nut bolts will be 24,000 pieces times the 190 expected value. That gives us 4,560,000 rupees. And keep in mind, in the exam, you need to explicitly write down that the 190 is determined based on management's estimate using the variable consideration rules.
And the leftover amount? The extra 10 rupees charged on those 24,000 pieces will go into a liability account. So, 24,000 times 10 equals 240,000 rupees. That is your liability provision, because effectively that money belongs to the customer, not us.
Section 6, Final Exam Recap.
We've practically torn both scenarios apart and solved them. Now, let's get into strict exam mode. The examiner needs to see your thought process crystal clear. In numerical questions like this, prominently stating your final figures is absolutely vital. The grand finale of your exam sheet should look something like this. Carlock's revenue, 34,560,000 rupees. Refund liability, 1,440,000 rupees. Asset for right to recover, 1,200,000 rupees. Then comes the nut bolts. Here, Q1 revenue is 4,560,000 rupees, and the refund liability is 240,000 rupees. Along with these figures, do not forget to underline keywords like most likely amount and variable consideration. That is what gets you full marks.
So I have to ask you, are you still afraid of IND AS 115? Have you completely mastered how to apply the most likely amount method? Apply this logic to any variable pricing or returns question and your answer will never be wrong. Retain this logic, apply it confidently in the exam, and I promise you will nail that 8-mark question. Keep revising, keep fighting, and I'll see you in the next power-packed masterclass. All the best.